The median American in their late 40s has a net worth of about $247,000. The top 1% of Americans own more stock market equity than the bottom 90% combined. Those are not two separate facts. They are the same fact told from opposite ends of the same broken system. Here's what I want you to understand before anything else. The gap between those two groups is not explained by how much money each side saved. It's explained by how they positioned it. The bottom group was sold diversification. The top group practiced conviction. And according to Federal Reserve data, through 2025, that gap has been widening without interruption for over 30 years. Before I get into why, let me give you the number that should make this video worth your next 15 minutes. According to Dalbar's quantitative analysis of investor behavior, the research firm that has tracked this gap since 1985, in 2024, the S&P 500 returned 25%. The average equity fund investor returned 16.54%. That's an 8.48 percentage point underperformance. In the fourth best year for stock markets in the last decade. In a year where sitting completely still in an index fund would have made you wealthy, the average American investor managed to extract only 2/3 of the available return. And 2024 extended a losing streak that now stands at 15 consecutive years of underperformance. This is not about stupidity. This is about architecture. Today, I'm going to walk you through exactly why the standard diversification playbook is the mechanism producing this outcome, and what the research says about how real wealth actually gets built. Here's the thesis. Conventional diversification, as sold to most American investors, is not a wealth-building strategy. It is a risk management framework designed by academics for institutional money managers in the 1960s, then repackaged and sold to retail investors as the path to financial freedom. Those are two completely different things. The confusion between them is costing the average 45-year-old conservatively $400,000 in eventual purchasing power. I'm going to show you 4 things. First, why the behavior gap isn't just about psychology. It's structurally caused by owning things you don't understand. Second, a peer-reviewed academic study from Arizona State University that should have permanently rewritten how we think about portfolio construction. Third, who profits from keeping you over-diversified and why that incentive runs directly against yours. And fourth, what the boring, unsexy, actually effective middle looks like for someone who isn't Warren Buffett and has no interest in becoming one. I have skin in the game, multiple hundreds of thousands of dollars invested, over a decade running my own business, surrounded by accountants and fiscal lawyers who taught me how money actually moves. The first thing they all agreed on: diversification beyond a certain threshold is a product being sold to you, not a strategy being built for you. Now, before we get into the escalating mess of incentives and academic research, I want to give you a metaphor that I'll come back to several times because it explains more cleanly than any financial equation what is happening to your portfolio. Imagine you have 1 tablespoon of butter. 1. You could spread it deliberately across 2 slices of toast and get 2 genuinely satisfying pieces of bread. Or, following the standard financial industry recommendation, you could try to cover 40 slices. What you get is 40 pieces of barely coated, mostly dry cardboard. You haven't managed your butter better. You haven't reduced your butter risk. You've made 40 bad pieces of toast instead of 2 good ones. The butter is your capital. The toast is your investments. And Wall Street has been selling you cardboard for decades. Keep this image in mind. We'll need it. In a few minutes, I'm going to show you a data set that reframes the entire question of why you own what you own. But first, I need to deal with something that sounds like a behavioral problem and isn't. Here's the thing about owning 40 different positions across 12 asset classes. You understand none of them deeply. You can't. There are only so many hours in the day. And if you're holding global small cap value funds alongside bond ETFs, alongside sector funds, alongside 3 separate S&P 500 trackers, you don't have a portfolio. You have a collection of things you half read about once and are now hoping someone else is watching. And when the market drops, which it does regularly, sometimes dramatically, you panic across all 40 of them simultaneously because you don't understand what you own well enough to know whether the panic is warranted. So you do what Dalbar has documented every single year since 1985. You sell at the wrong time. Withdrawals from equity funds occurred in every single quarter of 2024. The largest outflows came in the third quarter, right before a major rally. Dalbar measured what they call a guess-right ratio, the frequency at which the average investor times inflows and outflows correctly. In 2024, it fell to 25%. That's a record low. Investors guess correctly on market direction 1 out of every 4 attempts. Let's translate that to dollars. A buy and hold investor who started January 1st, 2024 with $100,000 in an S&P 500 fund ended the year with $125,020. The average investor making the behavioral moves that Dalbar tracked finished with $112,774. $12,000 evaporated, not because of bad stock picks, because of timing decisions made badly. Now compound that. Over 20 years, the same $100,000 left completely untouched in the index would grow to $717,500. The average investor, whipsawed by exactly the same type of decisions made year after year, ends up at $345,614. That's $371,000 of difference, not from bad companies, from bad behavior around ordinary investments. Here's a reversal you're probably not expecting. You think the problem is behavior. You think the fix is discipline. Just stop panic selling. Be more patient. Hold the line. That's the standard advice. But actually, the behavior is a symptom. The disease is owning things you don't understand well enough to hold through volatility. Warren Buffett wrote in his 1993 Berkshire Hathaway annual letter, "Portfolio concentration may well decrease risk if it raises, as it should, both the intensity with which an investor thinks about a business and the comfort level he must feel with its economic characteristics before buying into it." If you own 6 companies you understand deeply, a 30% drop in one of them generates research, not panic. If you own 40 things you barely understand, a 5% drop generates panic in all 40 directions simultaneously. 1 tablespoon of butter, 40 pieces of toast, 40 panic responses, none of them rational, because none of the positions are understood well enough to be held rationally. Stay with me, because this next part changes everything about how you should think about which investments actually generate wealth. In 2017, Professor Hendrik Bessembinder of Arizona State University published a paper titled, "Do Stocks Outperform Treasury Bills?" He studied every single common stock in the CRSP database, the most comprehensive record of American stock market history from 1926 through 2016. Over 25,000 individual stocks, 90 years of data. His findings should have caused a fundamental crisis in how the financial industry teaches portfolio construction. They did not. Here is what he found. When you compound each stock's returns across its full lifetime in the database, roughly 4 out of every 7 common stocks, 57%, failed to beat the return of a 1-month treasury bill. They underperformed cash. Not over one bad decade. Over their entire publicly listed lifetime. More extraordinary. When measured in terms of actual wealth creation, the entire net gain of the US, the stock market above treasury bills, since 1926, is attributable to the best performing 4% of listed companies. 4%. The other 96% in aggregate matched cash. Let that land for a second. Everything. The entire century of stock market wealth that convinced generations of Americans to invest in equities. The entire academic and financial industry argument for why you should put your savings in the market. All of it comes from 4% of the companies that have ever traded publicly. And Bessembinder's updated research through 2022 found that just 72 companies, 0.26% of all stocks ever listed, account for half of all net shareholder wealth of creation since 1926. Despite the fact that investments in the majority of stocks led to reduced rather than increased shareholder wealth, US Stock market investments on net increased shareholder wealth by $47.4 trillion between 1926 and 2019. The degree to which that wealth creation is concentrated in a few top-performing firms has increased over time and was particularly strong in recent years, when just 5 firms accounted for 22% of net wealth creation. Now, here is the logical implication that the financial industry has been dancing around for years. If 4% of stocks generate all the gains above cash, and your strategy is to own all stocks equally because diversification is the safe play, you are mathematically guaranteeing yourself that 96% of your portfolio contributes nothing above a bank account return. The premise of broad diversification for protection is built on the idea that you need to own everything to capture the gains. But the academic data says you need to own a specific 4% to capture the gains. Owning everything means owning 96% of deadweight. But Tom index funds solve this. If I own the entire S&P 500, I automatically own that 4% without having to find it. Yes. And this is actually the strongest argument in the entire video, just not in the direction most advisors take it. Hold that thread. We'll come back to it. By the way, hit subscribe if you like the content. Otherwise, YouTube's algorithm may never show you my videos again. Of all active large cap US equity funds measured, 79% underperformed the S&P 500 in 2025. Worse than the 65% rate observed in 2024, and the 4th worst year for active large cap managers over the 25-year history of the SPIVA scorecards. Over the 15-year period ending December 2024, not a single US equity fund category had a majority of active managers outperforming their benchmarks. 0 categories out of 22. Over 20 years, that number climbs to 92% of domestic funds underperforming their benchmarks. Think about what this actually means. If you are paying an advisor or buying actively managed mutual funds because you want professional help finding the right stocks, you have a 92% historical probability of finishing behind an unmanaged index fund, 9 out of 10, over 20 years. And then there are the fees. Fee drag compounds exponentially, not linearly. A 0.5% fee difference sounds trivial annually, but costs approximately $59,100 over 20 years and $165,800 over 30 years on a $100,000 initial investment. The gap nearly triples between year 20 and year 30 because the compounding engine has a larger eroding base in later years. Scale that to a $1 million portfolio. A 1% fee could shrink your portfolio by about 25% over 30 years, translating to nearly $1.9 million less on a $1 million investment. Not from bad investments, not from market crashes. From the percentage point you're handing over every year to someone running 40 fund pie charts in a quarterly newsletter. 1 tablespoon of butter, 40 fees. 40 rebalancing recommendations. 40 quarterly reports nobody reads past page 1. Here is where I need to tell you something about the infrastructure that keeps this going. Think about what the financial industry actually sells. Actively managed funds, wrap accounts, multi-asset allocation products, professionally managed portfolios. Every one of these things requires you to own many positions and to need help managing them. An advisor cannot scale a business around clients who own 5 companies they understand deeply and never need to rebalance. That's one conversation every 3 years. But an advisor running diversified portfolios across hundreds of clients, each with 40+ positions across multiple asset classes, is running something that scales beautifully and charges accordingly. There's also a structural legal issue here that most investors have never considered. Fiduciaries advisors legally required to act in your interest are often constrained by the modern legal definition of prudent investing, which is built on modern portfolio theory, which is built on diversification. To recommend a concentrated portfolio to a retail client is, in many advisory contexts, a compliance problem, regardless of whether the client understands and has genuine conviction in the specific positions. Your advisor is not diversifying you because they ran the numbers and decided it's best for you personally. They're diversifying you because the entire legal and compliance framework of their industry treats concentration as reckless, as a default position. James Olschlager, founder of Oak Associates, put it plainly. No hospital wings or college dormitories have ever been named by an indexer. They've been named by people who invested in one or two stocks and rode them for a period of time. The top 1% held about 31% of total household net worth in 2025. The wealthiest 1% hold more equity than the bottom 90% combined. Since 1989, the richest 1% have seen their household wealth more than quadruple from $11.74 trillion to $50 trillion. Their share of the national wealth pie increased from 23% in 1989 to 30.9% in 2024. The difference at the structural level is not that the wealthy were smarter at picking stocks. It's that they had conviction about a small number of things, understood them deeply enough to hold when everything felt like a crisis, and paid almost nothing in fees to do it. Now let me tell you about someone who wasn't doing any of that. About 3 years ago, a friend of mine walked me through his situation. Let's call him David. He's an engineer, mid-40s, makes solid money, and has been doing everything the right way since his early 30s, maxing his 401k, rebalancing twice a year, diversified across 15 different funds, large cap, small cap, international developed markets, emerging markets, bonds, real estate investment trusts, inflation-protected securities, dividend growth, sector-specific technology. His advisor had given him a beautiful pie chart with 11 distinct colors. David had roughly $320,000 in retirement savings at 45, which sounds reasonable until you run the numbers on what it actually cost him to get there. He'd been contributing about $1,200 a month for 15 years, $180,000 in total contributions. His all-in fee load across advisor and fund expense ratios was about 1.8% annually. At 7% gross market return, he was netting roughly 5.2%. And that's before the behavioral gap, the quarterly check-ins, the rebalancing in response to headlines, the time he moved allocation out of equities in the third quarter of 2024, right before the rally. He was tracking at about 500,000 below, where the same contributions at a 7% net return would have placed him. And he had no idea. The pie chart was too colorful to suggest anything was wrong. Here's the part where I want to talk about what the research actually recommends and why it's the part nobody is paid to explain. There are 3 levels to this conversation, and most financial content stops at level 1. Level 1 is stop trying to pick individual winners. Don't pay for active management. Buy a broad market index fund and hold it. This is the SPIVA data in practice. This is why Warren Buffett, the man who made a career out of concentration, reportedly instructed that 90% of the money left for his wife be invested in a low-cost S&P 500 index fund. Why? Because she is not Warren Buffett. For people who don't have the time, expertise, and temperament to build genuine conviction positions, Level 1 beats 92% of professional alternatives over 20 years. That is not a small statement. Level 2 is understand that most so-called diversification isn't actually diversification, it's fee multiplication. If you own 15 mutual funds and 12 of them hold essentially the same S&P 500 companies, you haven't spread your risk intelligently. You've paid 12 sets of fees for 12 copies of the same exposure. The Besson-Binder data suggests that the argument for index funds isn't that they spread you across everything equally. It's that broad market index funds automatically include the 4% of companies that generate all the gains at near zero cost without you having to identify them. That is a fundamentally different argument than spread your money everywhere to protect yourself. You're not protecting yourself. You're buying access to the winners without having to find them. This matters because it means you can do level 2 with 1 or 2 funds, not 15. Level 3 is for people with the time, discipline, and genuine expertise to operate the way Buffett described in his 1993 shareholder letter. If you are a know-something investor, able to understand business economics and to find 5 to 10 sensibly priced companies that possess important long-term competitive advantages, conventional diversification makes no sense for you. It is apt simply to hurt your results and increase your risk. But level 3 requires becoming that investor. Most people won't, and that's completely rational. The lazy middle, the place almost no one ends up because it's too simple to feel sophisticated, is 1 or 2 low-cost, broad market index funds, total fees under 0.1%, automated contributions, and 0 quarterly interference. That's it. Morningstar found that over the past decade, investors in US mutual funds and ETFs earned 7% annually, while the funds themselves returned 8.2%. That 1.2 percentage point annual investor return gap means investors missed out on roughly 15% of the fund's total returns. The irony is complete. The lazier you are, the better you do. And the financial industry cannot monetize that. There's nothing to sell to someone who buys one fund and never calls you. Here is the number that should permanently reframe how you think about complexity in your portfolio. Very few people have gotten rich on their 7th best idea. But a lot of people have gotten rich with their best idea. Charlie Munger, Buffett's late partner, was characteristically direct. A lot of people think that if they have 100 stocks, they're investing more professionally than they are if they have 4 or 5. I regard this as insanity. Stanley Druckenmiller, who ran one of the most successful hedge fund track records in history with George Soros, called diversification, the most destructive, overrated concept in our business. Look at George Soros, Carl Icahn, Warren Buffett. What do they have in common? They make huge concentrated investments. Now here's the part I want you to sit with. The academic case for broad index investing and the practitioner case for concentrated conviction investing are not actually in conflict. They agree on the fundamental diagnosis. Spreading money thinly across things you don't understand is the worst of both worlds. The index investor says, if you can't identify the 4%, own everything and let the index do the work at near 0 cost. The concentration investor says, if you can identify the 4% through genuine research and expertise, go there with real size. What both of them agree is wrong. Paying 1.8% annually to own 40 things you don't understand and rebalance based on quarterly anxiety. Here's what David's situation looks like from now forward. He has $320,000 at 45. He plans to retire at 65, 20 years. If he stays on his current path, 1.8% in annual fees, behavioral gap included his portfolio plus continued contributions, is projected at roughly $900,000 at retirement. By historical standards, that's above the median. The median net worth of Americans aged 65 to 74 is approximately $410,000. He'd be above average and still not financially free. If he consolidates to a single low-cost total market fund, automates contributions, eliminates the advisor fee, and stops quarterly rebalancing, same contributions, same market returns, the projection reaches approximately $1.4 million. The difference is roughly $500,000 in real inflated adjusted wealth. Not from stock picking, not from risk. From removing fee drag and behavioral friction that were structurally baked into a portfolio he was told was safe. David made that change. Consolidated to 2 index funds. Stopped the quarterly check-ins. Automated everything. He told me recently that the strangest part is how boring it's become. He has nothing to say at dinner parties when investing comes up. No stories about sector rotations or emerging market tilts. He has 2 funds, 1 spreadsheet, and a projection he now actually believes. He also told me he stopped checking his phone every time the market dropped because he finally understands what he owns well enough to not need to. Meanwhile, his previous advisor sent a quarterly newsletter titled Navigating Market Uncertainty. Page 1 featured a pie chart with 11 colors. Page 3 included a Benjamin Graham quote, "The advisor has almost certainly never read in full. The pie chart was beautiful. David used to frame them. And every single actively managed fund, in every single prospectus, contains the following disclosure. Past performance does not guarantee future results. The SPIVA persistence scorecard shows that consistent outperformance is typically fleeting. For large cap funds, results were even less than a random distribution would suggest, evidence that active outperformance, when it occurs, tends to be the result of luck rather than genuine skill. The disclosure and the data are saying the same thing. one just sounds better for the sales deck. Here is where the knowledge gap that most financial content leaves open actually lives. Knowing these numbers and building a system around them are two completely different things. I had access to the Dalbar data, the Spiva scorecards, and the Bessembinder study for years before any of it changed how I invested. What changed things was translating research into a specific executable framework. I built a digital book called The Exit Code for exactly this reason. It's 8 chapters of pure retirement research, 50 years of data distilled into a mathematical framework for identifying the specific date you can exit the rat race, not someday as a vague concept, but as a calculated number tied to your actual situation. Since this video is specifically about fee drag and the structural costs of over-diversification, 2 things in the book are directly relevant. The first is the lazy portfolio framework, a historically tested allocation that has outperformed most actively managed portfolios over 30-year windows, doesn't require you to pick individual stocks, and doesn't require you to pay someone 1% of your net worth annually to manage. The second is the dynamic withdrawal method, which replaces the outdated 4% rule, a withdrawal strategy designed in the 1970s for a completely different interest rate environment, with a framework that adjusts based on market conditions and actually tells you what you can spend without running out. The whole book costs less than a dinner out. You can find it through the link in the description. Every year you delay running the math, the compounding gap between where you are and where you could be widens. That's not urgency as a marketing tactic. That's how compounding works in reverse. 3 practical takeaways from this specific video, and I'm going to make them non-generic because generic takeaways are how financial content wastes your time. First, count your positions and ask yourself, for each one, what it actually does and why it belongs in your portfolio. Not from memory of what someone told you, from genuine understanding. If you can't answer that question for more than 5 of your holdings without looking anything up, you have an architecture problem. You have 40 pieces of toast. The solution isn't more discipline around panic selling. The solution is fewer positions you actually understand. Second, run your fee calculation on your specific situation. Take your current portfolio value, multiply by the total fee percentage you pay advisor fee plus fund expense ratios. Multiply by 22.4%, which is the approximate foregone wealth from a 1% fee over 30 years per dollar invested. If you have $200,000 invested and you're paying 1% annually, over 30 years, you're surrendering roughly $44,800 per 100,000 in foregone compounding. On 200,000, that's nearly $90,000. That's a very specific real number that either justifies your advisory arrangement or it doesn't. Third, understand the actual argument for index funds. It's not that they diversify you into safety across 500 mediocre companies. It's that broad market funds automatically capture the 4% of companies responsible for all stock market wealth creation, the Amazon, the Apple, the Altria, without requiring you to identify them in advance. The cost of not owning those specific companies is the entire argument for why equity investing works. The index fund is the mechanism that ensures you're in the room when they generate their gains, at a fee so low it's nearly invisible. Lazy investing built more fortune than crypto memes. And the most expensive piece of paper in your financial life might be the quarterly pie chart arriving in your inbox right now.